Good morning, everyone. Buenos dias. I hope you've recovered from a certain last second overtime final four shot that broke everyone's heart on this call. Uh, it's a pleasure to be here. Welcome to a UCLA event sponsored jointly by Bruin Professionals and the Real Estate Alumni Group. My name is Matt Weinfield, and I'm an MBA class of 2000, and I'll be moderating our event for the next hour. We will end promptly at 12:30. We are about to receive some real estate tax strategies from an incredible real estate professional, Guy Nicio, CPA. I'm looking forward to learning a lot. My firm, Weinfield and Associates, buys environmentally distressed properties. We've had some sales as well, and I have a feeling there's plenty of room to improve my personal and professional tax strategy, and Guy will be guiding that learning experience. Before telling you more about Guy, let me briefly share information about our two sponsoring organizations. First, thank you to the consummate BP and REAG professionals, Tara Neal and Peter Sapana, who are responsible for this fine event. Little Bruin Professionals background. It is the premier UCLA business networking organization. It is all about the three C's: commerce, camaraderie, and community. There are 12 regional networking chapters and 3 affinity groups. And I am now moderating the real estate affinity group of BP. And I'm going to tell you about one event coming for Bruin Professionals. There is a BP West Coast meeting, May 12th, from 4:30 to 6 p.m. So if you want to mingle with folks from San Diego, the Inland Empire, Ventura County, San Jose, San Francisco, Portland, and Seattle, you can do that. Little background about the Real Estate Alumni Group now. It was founded in 2000. It is a group comprised of alumni with various programs from various programs at UCLA, but prominently the undergraduate program, business school, and law school participate. We have over 400 members with satellite groups in Orange County, San Diego, San Francisco, and Nueva York, New York. I was just in Mexico, so I love throwing in the Spanish for what little I know. It's an exclusive and high-end real estate networking function. There's a job portal. There's discounts on development tours, educational panels, and networking functions such as this. The REAG is affiliated with the UCLA Ziman Center, which provides thought leadership in the field of real estate, influential research, and forums for industry professionals and policymakers. A couple of events coming very soon for REAG. On May 4th, you will hear about the future of office with a real heavyweight and Doug Holte, the former president of the Irvine Company. Another event on Thursday as well from 5 to 6:30 p.m. It will be a speaker spotlight on Michaela Connery and her work with the Kelsey in Northern California. The Kelsey focuses on developing affordable and inclusive housing for individuals with disabilities. So there's some events from our two sponsoring organizations. Hope you can attend those and others. Little logistics before I introduce Guy Nicio further. First, this event is being recorded and you'll be able to see it in its entirety on the Real Estate Alumni Group website. And Guy will speak for about 40 minutes, and there will be 15 minutes for Q&A. If you want to ask a question, I think we're all Zoom black belts. So you just go to the chat, and that chat is going to go to me and Guy, and I'll be selecting the questions while Guy is speaking, and then I'll feed them questions to Guy when he's done. And we always finish on time, so we'll be done by 12:30. And now the main part of today, I'm going to introduce Guy Nicio. Guy has more than 20 years of public accounting experience. He is the chairman of the Wines Tax Department and also serves on the firm's board of directors. He focuses on tax planning, compliance, and consulting with startup to middle market businesses and their owners, working closely with his clients to analyze and maintain the most tax efficient structure to suit each client's unique situation. Guy also heads up the firm's comprehensive office solutions group. This is very unique. Many accounting firms do not offer client accounting services such as bookkeeping, payroll solutions, sales, and use tax compliance and fractional outsourcing solutions. So Guy is an active Bruin, got a CPA and his MST. And I'll let Guy take it away now. He's going to share his screen and enjoy some tax strategies, everyone.
All right. Thanks, Matt, for that introduction. You always run a tight ship, so I'm sure we will be right on schedule, and I'll keep an eye on that whip in case I'm running behind at all. But I did take the opportunity to scroll through the list of names of attendees here, and I recognize quite a few of you. So hello and welcome. Good to see you again. For those who I've not met before, pleased to meet you, and hopefully I will have the opportunity to meet you in person one day at one of the upcoming meetings as the world starts to reopen. Hopefully we stay on the good track to do that. Anyway, how about those Bruins in March Madness? We did pretty good there. A slight disappointment at the end, but I think we got a lot further than most of us would have put our money on for that particular tournament, but good on that. So I wanted to give a shout out to those UCLA Bruins for the basketball tournament there. But I know many of you are anxious to hear what it is I'm going to be talking about today in 40 minutes, I guess, of time to talk about a variety of tax topics for real estate industry professionals. So I'm going to go ahead and share my screen. And so Matt already introduced me, so I will scroll right through these fancy intros and we'll just get right to it and talk from the beginning about choosing an entity. I think many of you have been in real estate for many years, and maybe some of you are newer to it, but I just thought I'd take a few moments to talk a little bit about the different entity types that we generally have to deal with in business, let alone in real estate businesses. So Schedule C is really the equivalent of a sole proprietorship. That's when you do not incorporate or become a partnership and you're just an individual who may buy property, for example, and you report it might be a rental property, a residential rental property, which is a very common thing that we see a lot of taxpayers, clients have, and that would just be reported on Schedule C of your personal tax return on 1040. And then there's an LLC or a partnership. Limited liability companies is what LLC stands for. And for those of you who don't study tax law like I do, a limited liability company follows the same exact tax code as partnerships. So really you look to the federal code in the partnership section to guide you on the rules for tax purposes for limited liability companies. And then we have the two types of corporations. There's the subchapter S corporation and a C corporation. Most of you probably who have been doing this for a while, the flags are going up like, yeah, but generally speaking, we don't put real estate in corporations, and that would be true, and that would be good advice in general. If somebody were to tell you that, there's a number of reasons for not wanting to do that. I'd say the default entity type that you would want to put real property in would be an LLC here in California, which is basically the same as a partnership. But here's some just check marks on what some of the differences are between, obviously you have to file a separate actual complete business entity tax returns for an LLC, S Corp, or a C Corp, and not for a Schedule C, since that's filed as part of your 1040. C corporations are bad for these purposes because you're subject to double taxation. And, for those of you who don't really know what that means, it means that the corporation, when it files a tax return, it pays taxes at whatever the corporate tax rates are, currently 21%. If any of you are following, recent news and watched the president's speech last night, you'll know that there's some changes on the table. We'll talk a little bit about that later. But in addition to the corporate tax rate, when you take money out of that corporation as an owner of that corporation, you pay a dividends tax, which is currently taxed similar to capital gains at 20% federally. So you're going to have to add your 21% tax at the corporate level, plus another 20% at the individual level for a dividend. And so you're already at 41%, and you may be subject to 3.8% net investment tax as well. LLCs and Schedule Cs, I said basis advantages. So, some of you have been doing this for a while. You know what tax basis is. It's the thing that, it's the higher the better in terms of minimizing your gain on the results. So in other words, if you pay $1 million for a building, your basis is $1 million until you start depreciating it, and then it goes down over time based on that depreciation. But The other thing about basis is you get basis in LLCs or partnerships for debt, which is a very common thing. One of the, I think, most normal things in real estate investing is that the properties would be leveraged. I mean, who wants to pay 10 million bucks for a building when you can, put 2 million bucks down and finance the rest at low interest rates? And the nice thing about that, when you're in an LLC or a partnership, is that you get basis for all of that debt, if it's qualified non-recourse financing or if it's recourse debt. But you do not get basis for that debt if you're in a corporate structure. So that's a big, big difference, especially when you're looking at S corps versus LLCs. You're not going to get basis. And so what that means is your distributions that come out of the entity will be taxable if they exceed your basis. Your losses will be limited to basis. And in real estate, everybody knows that depreciation often generates substantial losses. So there's some major differences in why really LLC and partnerships is really the default structure. Your higher audit risk if you're doing Schedule C or if you're not incorporating, because IRS knows that people can just put numbers on a 1040 pretty easily, so they look at that closely. You do pay self-employment tax if it's not passive income on these two entity types, Schedule C and LLC or partnership. And then we'll talk a little bit later more about Section 199A benefits, which is a 20% deduction on qualified business income. But that's eligible for 3 out of the 4 entity types, not eligible for C corporations. And then in terms of flexibility, well, it's your partnerships and C corporations both have high marks in flexibility, but for different reasons. And we won't go into too much detail since this is today's discussion will be as high level as possible while still giving you some valuable insights. Obviously, we can spend a day or a semester learning in depth some of the technical strategies behind these things, but the key is to give you some useful information that you can take away and maybe do something with it, follow up on it, talk with your personal accountants, or do some additional research and see what applies to you. But this next slide here, 1031 exchanges. So we're going to start this discussion today with what feels probably very familiar to most of you. I'm sure almost everyone has heard of, and maybe most of you, or some of you at least, have already done either one or more 1031 exchange transactions. So 1031 exchange, or it's also known as a like-kind exchange, that's just a section of the tax code where it says, and here it is in quotes, no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment. So in other words, it can't be your personal home because that's not for trade or business, and theoretically that's not for investment. The primary purpose is to live in it. If such property is exchanged solely for property of like kind, which is to be held for those same purposes. All right, so who qualifies for a 1031 exchange? Well, pretty much everyone does. Individuals, C corps, S corps, partnerships, LLCs, and trusts. As long as they meet all the criteria and follow the rules, you can qualify for 1031 exchange. So what kind of property qualifies? Well, we already talked about that it's got to be held for use in a trade or business. The quality or the grade is not important. So, whether it's a good property or bad property, whether it's a raw land or apartment complex, those are all qualifying properties that you can exchange, but it must be real property. And by the way, some of you may be familiar with DSTs or Delaware Statutory Trusts. You can do a 1031 exchange into a DST and it will qualify as long as the DST holds the qualifying underlying real estate. So with that said, for those of you who follow the crypto world and Bitcoin, the joys of having excuse me while I close my door, I have a barking dog in the background. That's the beauty of the remote world that we live in these days. All right, so can you structure Bitcoin for Ethereum as a 1031 exchange? And if we were live and in person, I'd be looking around the room and seeing if anybody has answers, but we're not. So I'm just gonna say, I'm gonna read on. How about machinery equipment? Can you do that? Can you trade in a business vehicle under 1031 exchange and defer the taxes? Well, the answer is you used to be able to, but not anymore. Since the Tax Cuts and Jobs Act that was passed in late 2017 and became effective for tax years beginning after 12/31/17, it only applies to real property, and most of you know that. But that's really not that long ago. I advise a lot of clients, well, not a lot, a good handful of clients that have been trading in cryptocurrency for a while. And in the early years of that, so back in 2017, when it had its first recent run, I guess we'll call it, you were able to qualify for 1031 exchange treatment for those, but now that doesn't work anymore. And so it's a big deal for some of those folks. All right, so let's look at a little diagram here. So you sell your property, Yeah, and this is the key, and most of you know this. You can't take the proceeds and then just plan to use them for the replacement property. You sell a property, you've got to have a qualified intermediary set up in advance, and that intermediary really acts as the buyer of the new property and the seller of the old property, and you never take the cash. If you do get any cash, whether it's part or whole, it's considered boot, and it's going to be taxable to the extent of that. And by the way, debt relief is also considered boot. So if your debt on the replacement property is not as much as your debt on the relinquished property, that does add to your boot calculation. It's the same as getting cash. So most of you know this, but you have to identify the replacement property within 45 days of the sale of the old property, or so the close of escrow, if you will, and then you have to close and purchase within 180 days. So you can identify multiple properties. But again, most of you, this is probably review for a lot of you. There's a reason why I'm spending a fair amount of time reviewing it and talking about it. They've been a very powerful, wealth accumulation vehicle for savvy real estate investors for decades. But here's the question: should we continue to utilize 1031 exchange as a primary tax strategy? Well, the answer is, well, yes, as long as you can, I think, when it applies to you, and if that's the best option, if you want to continue to own the real estate. Obviously, there are some business purposes that will, override tax motivations, but really from a tax standpoint, if you don't need the cash, and if you want to continue to own real estate, 1031 exchange will continue to be a valuable tool for as long as it exists, if it continues to exist. And what does this mean? Maybe, but only if you can, limited time only. Well, again, for those of you who follow, Biden's got a tax plan proposal that may eliminate 1031 exchanges. That's a big ticket item. And we don't know exactly where it's going to land, but if this does happen, it's going to be an historic tax event for real estate space. So it's something that we should have on our radar and be planning for. So here's some other potential changes relevant to the real estate industry. So some of this you may or may not find relevant, but I think most of it crosses over in some way, shape, or form. The top tax rate for individuals with income over 400,000 is going to increase back to what it was before Trump, basically 39.6%, plus the 3.8% net investment income tax on top of that. But this is a new one, and one that maybe some of you don't really like. Capital gains rates, maximum increase from 20% today, again, plus the 3.8% if you're subject to it, to 39.6% on gross income greater than 1 million. Or I originally, when I wrote this up, it was the word was, it could be a 400,000, it could be a million. But for all you fine folks, I thought you were deserving for me to update this as of this morning. So based on the tidbits that came out of the fact sheet from Biden's speech last night, I went ahead and updated. So anything that you see in red, hopefully you see a color here, anything you see in red is going to be specifically stemming from last night's speech on the tax proposal and the facts that were presented by Biden last night. So 1 million and not 400,000 is what he said in that release. So gross income over 1 million, basically doubling the capital gains rate, and that's huge. So that's something we definitely have to plan for. In addition to that, repeal of the 1031 deferred exchanges. Now this is in red because they did say that was on the table. Repeal of Section 199A deduction for taxpayers with income over 400K. Well, that was something that's been talked about for a while now, but they didn't address it in the American Families Plan last night. So it doesn't mean that it's not going to happen, but it wasn't one of the items that were specifically highlighted on the fact sheet. A repeal of bonus depreciation rules. I think most of you who've owned real property are familiar with bonus depreciation by now and probably have taken it. Here's a big one: state and gift tax increases and substantial reduction in lifetime exemptions. This may not sound like real estate, this last one, but I can tell you for those wealthy folks, and I don't know, your definition of wealthy may be different from one person to the next, but if your net worth is in the 7 figures, or especially multiple 7 figures, you or your clients or your people that you work with, this is going to apply to you, and something that you should definitely have on your radar. But as much as it's been talked about for months leading up to today, the American Families Plan did not address this last night. So that was interesting. But again, we don't expect that to go away. It's been a hot topic. There's a limitation on use of valuation discounts, elimination of basis step up upon death. That's huge. For those of you who don't know, if you inherit property that, let's say your grandparents owned, that they paid $10,000 for 40 years ago, and now it's worth $3 million. Well, under current law, you get a step up in basis. And so it's like you paid whatever the value is on the day they died. And so you don't pay any tax on the sale if you sell it the following day. All right. So what else? let's talk a little about Section 199A deduction, because it does apply to many real estate businesses. If it, this is not going to qualify for triple net lease situations, but for basically those types of real estate entities that rise to the level of trader business. And that's a very subjective, long debated topic. But to the extent that you are taking the position that you qualify for trader business real estate, you can take this Section 199A deduction, which is 20% of your qualified business income, which is basically taxable income adjusted with some minor adjustments. But so you effectively look at your income for that activity, subject to certain limitations, and it's a 20% deduction right off the top, as long as you're not a C corporation. It applies to individuals, including sole proprietors, S corporations, and partnerships. All that pass-through activity, you get a 20% right off the top. Now, here's a couple of the rules. I don't want to get too technical on this, but they're here, and I'll make these slides available to you through Matt if he's willing to distribute them later. But I put some of the information on here for that purpose. You can take it with you and look through it and talk with your accountants or advisors or whoever, and have enough information to move forward with that. So here it is. It's limited to 50% of your W-2 wages, or 25% plus 2.5% of unadjusted basis of all the property. All right. So again, this was talked about a lot, being on the chopping block. So, what can you do about it? Well, for one, it hasn't happened yet. They haven't taken it away yet. So for now, if you haven't for the last couple of years already been taking advantage of this, it's something you may want to look at. If you've not been taking the 20% deduction, you want to make sure you have the proper entity structure. So you want to review that. Qualifying trades or business to have taxable income. So in other words, remember, it's limited to taxable income. So if you don't have any income, then you're not going to get the deduction. Well, one of the things that is very common to eliminate income in real estate holdings, real estate investments, real estate businesses? Depreciation deductions. And depreciation deductions are just a timing thing. So you really have a lot of flexibility as an owner or manager, if you will, of real estate and real estate investments to take depreciation under different methods: straight line, bonus, 179, cost segregation studies. We'll talk a little bit about that. There are a lot of ways to accelerate it and take it up front if you need it, or let's say that you don't need it faster, you already have enough and you're just under certain limits and you want to take advantage of these deductions. Well, you can play a little bit of do a little planning around those depreciation deductions to make sure that you qualify for that 20%, because that's a big difference in tax rates effectively. What else? Consider review of fair market rent agreements between related parties. So I know a lot of clients of mine have operating companies that basically rent space from their own LLC, where in other words, they own the building and they rent from themselves. Well, you can have a rent agreement where you're paying rent from one end to the other, and the ability to structure that, and there's some subjectivity in there and what fair market value means. So you can actually structure the amounts so that the numbers land where it's tax optimal to you. Tax projections using different, we talked about that. Multiple entity business owners may have flexibility in shifting where profits result. So many people, many clients, taxpayers, they own multiple businesses, and there is, you work with your accountant to optimize your tax results based on things like this 20% deduction, things like depreciation. Remember, you have to consider, and again, we don't have time to get too technical, but there's the whole passive income versus active income consideration, where you cannot deduct passive losses against active income, and passive losses are commonly like rents from real estate. So shifting results through these agreements, and maybe you have a lot of times you have leased employees from one where you're, even though the payroll may not be on one entity, the way that you shift some of the expenses over the other entities through leased employee arrangements. So there are a number of management fee arrangements. That's a way that you can shift expenses or share expenses between entities to make sure that you're getting what you deserve in terms of the optimal tax outcome. All right, so monitor legislative developments and maintain your forecast. Prepare to pivot for optimal 199 deductions, and then there's more here. So let's move on to this next topic: is estate and gift tax under Biden's proposed tax plan. Again, they didn't talk about it much last night, but this is a huge deal for basically high net worth individuals and families, multi-generational wealthy families. Right now, and again, some of this may be review for you, but for those who it's not, current law says that everyone has an $11.7 million unified estate and gift tax exemption. So if you're married, two of you have 23.4 million together. And currently that's scheduled to sunset or go back to 5 million at the end of 2025. So what does that mean? Just real quick. It basically means that if you have an estate when you die, that's $11.7 million and you're single. Well, if you leave that to your heirs, whoever they are, they get all of it, right? They don't have to pay any estate tax under current law. But if there was, $12.7 million, well, that extra million, the million over 11.7, they'd pay 40% estate tax to the federal government on that money. So why is that a big deal? Well, they're talking about moving this exemption. Not only is it already going to sunset and reduce back to 5 million, but they're talking about reducing it to as much as 3.5 million per person, which is where it once was. That's a big deal. And maybe even splitting the lifetime exemption and the gifting exemption. One of the strategies to take assets out of your taxable estate, and remember the current tax rate for estate taxes is 40%. You'll see on the next slide that it's going to potentially give you an increase from there. 50, 55% were a couple of numbers thrown out there. But if you, one of the strategies again is to gift assets for a discount out of your estate to your heirs early, maybe minority non-controlling interests. And that really, that strategy is probably what I would consider low-hanging fruit for those in the know and for those who it applies to. It's where you can save millions of dollars in taxes. I've seen discounts being taken of 30 to 40% on gifts. So that means that if you have a gift of $1 million that you're giving to your son, well, for purposes of the gift taxing exemption, they're only counting 60 to 70% of that gift against you. So it's only $600,000 or $700,000 charged against your lifetime exemption, but yet you're getting $1 million out of your estate and all of the future appreciation. So hopefully I'm not going too quick for most of you. This is a concept that, and you'll hear more about it in the next couple of slides. You'll want to pay attention to if you're someone who's in the 7 figures or someone who you advise or are partners with. It's time to really take a really hard look at this before tax reform is finalized. Let's go on to the next one. So here it is. Estate and gift tax rate is currently 40%, and Biden's expected to try to raise this rate to at least 45%. So the expected effective date for any change to tax rates is expected to be January 1st, 2022. However, consider the possibilities that it is not impossible to have a retroactive enactment, which would be very bad, and be to have it take effect as of the enactment date. In other words, whenever that becomes law. So the American Families Plan, again in red from last night, the only thing they really addressed last night was the step up in basis for inherited assets on gains in excess of $1 million or $2 million for joint filers before any real estate gain exclusion. They didn't talk a whole lot about this, but this has been talked about for months, and we don't expect it to go away. And I do think that it's going to become part of the tax reform that we see from Biden. All right, so if this is expected to happen, what can I do about it? Well, here you go. Not very complex, but call your law office. So for all of you real estate attorneys or estate planning attorneys that do work in this space, you're welcome. These are the people, well, maybe not, maybe I should say sorry, because right now, these are the busiest people on earth. Estate planning attorneys for high net worth individuals are having their busiest years ever. Why? Because of the expectation that they're going to roll back this lifetime exemption, and people are trying to get assets out of their taxable estates at discounts, at lower rates before it's too late, before it becomes a taxable event to gift these things to your heirs, or until you're stuck holding it until you die, and then 50 or more % of it is going to the government, which is not what anybody spent their lifetime building their wealth for. All right. So, by the way, this is none of this is meant to be political in any way. I'm a tax advisor, so my job is to minimize taxes. I do realize that there are some social benefits that come from these tax revenues, so let's consider that a separate issue altogether. All right. So, what are some of the things that you can discuss when you go talk to your estate planning attorney? Gifting strategies to remove assets from your potentially taxable estate. Getting appraisals done ASAP and discounts in connection with gifts due to lack of marketability discounts and lack of control discounts. Utilize specialized trusts, which are available to remove assets from your estate, and a lot of times allows you to retain control and even direct where your assets go, charitable remainder trusts and things like that at post-mortem. Target appreciating assets, and of course, fractional minority interest, which I already talked about. All right, so depreciation we've talked about a little bit here, But bonus depreciation is another one of those things that is kind of on the table of going away. So, it's one of the few, it hasn't been around forever, but bonus depreciation, you take 100% of the qualifying property upfront, in year one when you spend it basically. And that's a great tool to be able to utilize to minimize tax on, high taxable income entities and situations where real estate business endeavors to maximize the deductions through depreciation, through things like bonus depreciation. And a lot of times that bonus depreciation has to happen in connection with the cost segregation study, which for those of you who are real estate experts in investing, you've probably done one or two of these by now. For those of you who have not, this is a very, very powerful tool. Cost segregation studies will allow you to take, oftentimes even buildings that you've owned for years, do a study on it and basically separate the millions of dollars in cost basis into these different categories, shorter life categories, 5-year assets, 7-year assets, 15-year assets, which also qualify for bonus. So then you can take 100% and you can really front load a lot of those deductions. And that leads to a lot of, cash flow advantages, time value of money, et cetera. And then the crazy thing about cost segregation studies, and I've done this for a number of clients over the years, is I actually had a client die a couple years ago who owned probably $100 million in commercial properties, and we had done cost segregation studies on all of them probably 5 years prior to his death. And the awesome thing, from a tax perspective for his family was, even though we took all that upfront deduction for depreciation in the cost seg studies for his properties, when he died, the basis step up went right back up to fair market value on date of death. And so you got those free deductions and you get the full basis right after that. So if you haven't heard that as a strategy, that's definitely something that, has always been available under the current law, and something that continues to be available until and unless it changes. All right. So, but beware of the near-term taxable sales and the resulting. So in other words, if you're not going to hold some of these properties, you're going to take depreciation on or cost segregation studies, and you're planning on selling it, in the near term, well, obviously you're going to have, your gain is going to increase as a result of those depreciation deductions. So you should plan for that accordingly. It needs to be part of your overall projection, and seeing whether or not it even makes sense to spend the money on that and to take those deductions timing wise. All right, so I'm going to shift gears a little bit here. Not going to get into as much depth as I normally get into when I do an opportunity zone presentation, entirely in opportunity zones, because there's a lot to talk about there. But to make sure that everyone has some insight into opportunity zones, which is, I think, going to continue to be actually going to become even more important as we see tax reform happen. So what is an opportunity zone? Well, first of all, there are 8,700, over 8,700 zones that have been designated as such in our country. And these are basically economically disadvantaged areas where they want to incentivize investors to put money into these areas and get some very substantial tax benefits. So what are the benefits? You get deferred capital gains, you get tax-free appreciation, reduced capital gains. We'll talk about that in a minute. Disadvantages, some of this stuff is new, it's untested. In other words, is it going to be a viable investment? There's uncertain community benefits and high buy-in prices. All right, so this is kind of what it looks like. Taxpayers, so it starts with having a capital gain event, all right? In other words, any capital gain. So you sell something this year, you're looking at capital gains, and you're going to pay tax if you do nothing on that capital gains. And capital gains can be the sale of, equipment, the sale of a business vehicle, sale of cryptocurrency, the sale of real estate. All of the above qualify for this. So you are allowed to invest whatever the amount of capital gains that you have recognized into an opportunity zone fund in order to receive these tax benefits. You just have to do so within 180 days of the sale. That's the general rule. I'll talk about in a little bit later how you can have more time than that. But the general rule is, once you sell a property or an asset to generate capital gains, you have 180 days from that sale to invest in a qualified opportunity fund. Now, you can invest in your own fund that you create if it's worth it, because you have a giant transaction that's maybe, a lot of people sell their business, maybe they have a $50 million gain that they're looking at, and now what do I do? So you can start your own fund, which really just is an entity that qualifies as a fund because you have opportunity zone business property, which is the third component here. You have to invest in qualified opportunity zone property, which we'll talk a little bit about. But again, there's a lot of information on this particular incentive. So I'm trying to give you enough tools to be aware and know how to follow up if it applies to you. So let's see, temporary deferral, capital gains. So the deferral, so the first benefit is you get this temporary deferral. In other words, if you have this event, when you put the money into this opportunity zone fund, you don't have to pay it today, but at the end of, well, it's about 6 years from now, or 5, I think now, at December 31st, 2026, you will recognize that original gain minus any step up that you may or may not qualify for. So at a minimum, you're going to get to hold off from paying the taxes on those gains until basically the due date of your 2026 tax return. Okay. If you get your investment in by the end of this year, you'll get a 10%, I guess we'll call it forgiveness of that original gain, and you never have to pay it back. It used to be 15%, but you missed the other 5% window that expired at the end of 2019. And then the big win is if you continue to hold that investment in that fund for 10 years, all of the appreciation is tax-free from the moment that you invested it. So if you invested it, you know, say December 31st of this year, and 30 years from now, you sell it and you have a $10 million gain, well, that $10 million gain is tax-free because of the Opportunity Zone Fund. So that's huge. All right, so this kind of talks a little bit more about what I already talked about. I'm just going to keep on rolling right through this, and just Matt, just how am I doing on time? If you don't mind, are we? It's at 12:11 now. What time should I be shooting for?
5-7 minutes more.
Okay. All right.
Just a reminder to all the attendees, feel free to chat me some questions. If you don't, I will ask some questions myself, everyone.
Awesome. Thanks, Matt. All right. So I'll just roll right through these slides. These are some that again, I'm sure Matt will be one to share with you that you can take with you and kind of see how this all flows through. But basically there is a bill, I will say, like, right, the 5%, you can't get a 15% step up. It's only 10% that's available to you because after 2019 that expired. But there is a bill out there that they're trying to push through to extend it by 2 years. And if that happens, that's going to reopen up the floodgates for the full 15%. So that means you're going to be eligible potentially, if that happens, to be forgiven of 15% of your original gain. But again, the real big win is the 10-year hold, which leads to full forgiveness of all the appreciation. And that's what it kind of talks about here. All right. So I said earlier that it's 180 days, but really, you know, if you're a partnership, for example, you have more than 180 days. The partnership has 180 days, and if the partnership chooses not to do it, you as a partner, even if it's just you and your, I don't know, brother, for example, you can each decide, well, I want to do it, and you're going to actually have 180 days may elect to start counting the 180 days beginning on the due date of the entity's tax return. So really, in this example, this is a year old now, but it would take, you have to count 180 days, by the way, not just 6 months. So you count days on the calendar, and in 2020, this would have taken you to September 11th. So don't think that you run out of time. If it's in an entity, any pass-through entity, not only do you don't even start counting until the end of the year, the first day of the following year. All right, so there was some COVID relief. This one's already behind us. For those of you who may ever consider starting your own fund because you have a large transaction, you do have to substantially, you can't just buy the property and let it sit there. It's got to be either substantially approved or original use. And then if it is going to be substantially improved, you have a 31-month window to do that. So there are a number of rules here that it talks about. And then this slide here talks, kind of compares and contrasts the opportunity zone versus 1031 exchange. So the use of property, they don't have to be like kind for opportunity zones, but they obviously they do for 1031 exchanges. The nature of the property, well, it can be any property for opportunity zones, and only real property, no personal property for 1031 exchanges. There's no identification or replacement property requirement for opportunity zones. And by the way, opportunity zones is a great tool to have at your disposal if you're ever involved in a failed 1031 exchange. I think it's the only last resort type tool I can think of that if you're in a 1031 exchange, you don't close or you don't identify, and all of a sudden you're looking at this taxable event. Well, all of a sudden you should be looking at opportunity zones. All right, well, I didn't really want to pay the tax and I still want to be invested. Opportunity zones can be the savior because you don't have to figure this out in advance. You have 6 months or more to fix it after the sale of a property. So You're limited, however, to one of the 8,700 zones in opportunity zones, but whereas you can do it anywhere in the U.S. for a 1031 exchange. And you know, the rest of it you can just read through right here on your own. But you know, obviously, I talked about the benefits earlier. So what are a few takeaways from today? You know, Biden's tax reform will substantially impact real estate. It's unprecedented what we're going to see here. So everyone should be aware and prepared. There's a limited window to execute certain strategies. If there's 1031 exchange on the table, if there's gifting strategies on the table, you want to move assets out of your taxable estate, you have a limited time frame to do that potentially. Nobody really knows where legislation will end, but you have to be prepared to make moves while you can. Either way, review deal flow and possibly execute tax optimal transactions. Work with a knowledgeable estate planning attorney and CPA to execute on these, and be prepared. Stay informed, plan, and be ready to pivot. All right, and that leads us to the end of our presentation.
I think last bullet point, everybody needs to write Joe Manchin, is that Democrat that's always on the always a tiebreaker here. So everyone needs to write to Joe Manchin, say don't allow these tax changes to take place. I have some questions rolling in, and before I dive into those, Guy, would it be okay if we sent everyone your presentation that signed up?
Yes.
Or would you prefer that they just contact you to get it?
No. It's absolutely okay.
Okay, I texted Tara about this.
Okay.
And so Tara's going to send to everyone who attended and could not attend and signed up is going to get your presentation. So there are a lot of detail and we didn't give you a whole bunch of time. So here are some questions. Guy, can you clarify the $2 million limit on step up in tax basis, in particular the excluding real estate part?
Let me start by stopping my share. I don't think. All right. So that $2 million thing is brand new from last night, by the way. So let me go back and review. So that was on the. What was the say the question again, Matt?
Sure.
Sorry.
And David, if you'd like to provide more details in the Q&A, feel free. Can you clarify the $2 million limit on step up in tax basis, in particular the excluding real estate part?
So basically they're saying that that it would only apply to joint taxpayers with income over 2 million, rather than just across the board. And the excluding, not counting exclusions means, like something like, for example, the personal residence exclusion that you can take up to $500,000 and take it out of the game. That would be an example of an exclusion that you would take out of that calculation.
Do you want to go back to the slide, or are you comfortable? Okay. Thank you, sir. And by the way, thanks so much for being on the minute, Johnny on the spot. I mean, everyone realized we got information just from last night's State of the Union. That's rarely done so quickly. Thank you, Guy. Okay. Jeff asked, given potentially higher tax rates in 2026, when the deferred tax is due, is there a particular rate of return you need over the 10-year period for a QOF to be better off than just paying the tax in 2021? Ooh, that's quite analytical.
Yeah, and that's I probably refer you to more real estate investment experts than me. I'm not the investment advisor guy who's going to give you the rate of return optimal outcome. So that's really outside of my wheelhouse. I'll give you the tax implications and I can probably do projections, but no, unfortunately, what the rate of return in on an investment is more, a real estate, professional advisor's role than it is mine. So sorry, I can't help you there.
Here's a very taxi question. Now, things got the submittal date got delayed to May 15th for the returns, right?
17th.
17th. Oh, thank you. And then do you think there's going to be a delay in the corporate tax? Or do you think that's still going to be mid-September? Any word on that?
No. So
on the extension, I should say.
No, I mean, I don't expect there would be, since they basically did not extend the original due date that was April 15th for calendar year end corporate tax, C corporation taxpayers.
Oh, okay.
There's no reason why. So we had to file all those by April 15th or extend them. So we would not expect that they would extend the extension date.
Thank you. Here is a very qualitative question. So you see a lot of real estate investors. Who's doing the best out there? Now you hear all these stories about, being the retail apocalypse, the retail Armageddon. Are you seeing certain trends among your real estate, the folks who hold a lot of real estate that are doing really well? Who's doing the best out there that you're seeing?
There's I hear a lot. Believe it or not, I hear a lot of really good big wins for some of the clients that we have, and we have clients that are individual investors as well as that manage funds. And I think one of the things that most of is, like take industrial real estate for example. Oftentimes it's impossible to find desirable inventory on the market, especially if you're in a 1031 exchange and or you want to stay here in California. It's very difficult. So the competition is huge, and I think because there are investors, for example, like Opportunity Zone Fund developers who have popped up all over the country, who are looking to acquire qualifying property and develop it and meet all these requirements. They're making offers that are, just well above what you would have expected, 1-2 years ago. So, I've got some clients that we're working on some projections now that they basically they have a fund that's a real estate investment fund, and this particular one is multifamily, large apartment complexes. I think it's mixed use, and they were never planning on selling because it was going to be a long-term hold, and they have a great pro forma, but they received an offer they couldn't refuse. And those are the kinds of things that I'm seeing basically on the market, is that, and I think people are seeing the same thing in residential real estate, obviously, at least for now. People are buying sight unseen. My own sister, who lives in Huntington Beach, sold her house recently, and the buyer never even came and visited the house. He just wanted to close on the deal before anyone else had a chance. So I don't have a whole lot of retail clients, so I'm not sure if those have rebounded much. Obviously, they've been impacted adversely by the pandemic, but I think they were using the opportunity for improvements, because we've seen a lot of money spent to do some improvements, and we continue to have available to us the bonus depreciation to take deductions for those. But people still need to be somewhere. I think it's just a shift in how some of these real estate properties look and how they're used.
Well, I've got another very taxy question. What are some of the biggest errors you see from a tax standpoint for real estate investors? What you see time and time again is like, oh my gosh, why did he do this? He could have saved so much. I mean, you've probably touched on things in your presentation already, but I hear stories where people have done their taxes and then they take their taxes to a real estate expert such as yourself, and you just redline it and make all sorts of suggestions. So what are some of the common mistakes you see for real estate investors?
Well, the two obvious ones are, one that I've already talked about is not doing a 1031 exchange. I mean, believe it or not, and usually those are non-sophisticated investors, but I have seen someone sell real estate without going through a qualified intermediary, have to pay the tax, and then they went and bought some other real estate. It just, that's a big, mistake, basically, because they didn't have the right advisors, or maybe any advisor. But another one is, and this could all change now, but a big mistake has been a lot of families where their parents are aging, and the aging parent doesn't need the house anymore to live in, and so the kids will go and sell the house. Well, likely they owned it, and it could be any property. Let's say it's a building, whatever it is, they sell it. You have a parent who's 80, 90 years old and probably not going to live to 100, maybe not beyond 2 or 3 years, depending on where you are in the example. Well, obviously they're going to miss out on all the opportunity to get the step up in basis and relieve all that tax liability. So the fact that they would sell it in that situation prior to just waiting till the parent, I guess, eventually dies, is going to generate, and has generated, hundreds of thousands in tax liability that didn't need to be there at all.
Those are hard conversations to have, I'm sure, within the family,
Yeah.
though.
And the last one I'll just say is really in line with what I've been talking a lot about, and how important it is. And it's the failure to have any estate plan in connection with what the assets in your estate. Particularly for high net worth individuals, if you're looking at estates that are in the 7 figures and up, multi 7 figures, and there's no estate plan and there's no gifting strategies being executed, they're really going to ultimately cost their heirs millions of dollars in taxes on that one day eventual death.
Well, kudos to you for this presentation. It's very informative, and I've never seen anybody compare 1031 exchange and op zone, so I know everyone's going to look forward to your slides. And I see no more questions coming in. I want to thank everyone for taking part, and thank Guy for prepping a great presentation. Guy's available for questions, and everyone enjoy things as we start to open up in LA and Orange County or wherever you are. Be well, everyone. Thank you, Guy. Take care. Go Bruins.
Thank you, everyone. Thanks for having me. Take care, Matt. Thank you.